There's an old saying that if you see one cockroach, there are always more hiding behind the walls. A single small bank failure doesn't happen in a vacuum. It often signals deeper problems spreading quietly beneath the surface. To understand what could come next, we need to understand what caused this bank to collapse in the first place. On paper, Metropolitan Capital Bank looked fine. It held about $261 million in assets and $212 million in deposits. That sounds healthy until you take a closer look at what banks actually call assets. Most people think of assets as something valuable and liquid, like cash, property, gold, or silver. But for banks, assets are usually someone else's debt. Loans make up the majority of these assets. When you take out a mortgage, that loan is your liability, but it's considered an asset for the bank. The same applies to business loans, commercial real estate loans, and even treasury bonds. The problem is that across the U.S. banking system, many of these so-called assets are sitting on massive unrealized losses. Banks can't sell them for anywhere near what they paid or what they're valued at on paper. That makes them effectively illiquid. In this case, roughly 82% of Metropolitan Capital Bank's portfolio was tied up in commercial real estate and private equity funding. Commercial real estate used to be viewed as one of the safest investments imaginable. There was always demand, but that assumption no longer holds. And while it would be comforting to say this bank was an exception, the reality is far more concerning. More than half of all commercial real estate loans in the United States are held by regional and mid-sized banks. That means the same risk exposure exists all across the country. There is a serious and growing crisis in commercial real estate, even though the mainstream media barely talks about it anymore. Delinquency rates are at record highs. Office buildings are sitting empty. Strip malls are vacant. Entire complexes have no tenants. Many property owners simply cannot refinance their loans at today's higher interest rates after years of zero or near zero rates. The math no longer works. So why hasn't everything collapsed already? Because the banks are trapped too. If they force these loans into default and take the losses, they expose the fact that their balance sheets are far weaker than advertised. Instead, they're playing a game known as extend and pretend. Loan terms are quietly modified, maturities are pushed out, and grace periods are offered, all to keep these assets looking alive on paper, even though they're effectively worthless. And it doesn't stop there. Private equity has been using similar accounting tricks. Recently, it was revealed that private equity firms are selling massive amounts of debt to each other at inflated values. On paper, these transactions create billion-dollar assets, but the underlying value is often little more than financial smoke and mirrors. Now layer in one more critical detail. Banks are currently required to hold zero reserve requirements. In March of 2020, the Federal Reserve eliminated reserve requirements altogether, allowing banks to operate without any meaningful safety buffer. That decision maximized short-term profits, but it also removed the last real line of defense. The system has been kicking the can down the road ever since, and now it's operating on the edge with no margin for error. Some people might say this is still no big deal. One small bank failed. It doesn't affect you directly, and technically that's true. But this isn't about one bank. It's about what this failure reveals. On the surface, everything can appear calm and stable, but when the foundation is cracking underneath, that calm doesn't last forever. When this pressure finally breaks, it will affect everyone. Right now, regulators are working overtime to keep this story from gaining traction, calling it an orderly wind down and insisting everything is business as usual. But here's the uncomfortable truth. The FDIC insurance fund holds enough money to cover less than 1.4% of all insured deposits. If widespread bank failures occur, that fund would be depleted very quickly. Imagine being told your insured dollar is only worth a penny or two, and that's assuming you get anything back at all. It would only take a few mid-sized bank failures to drain the fund completely. At that point, the system faces two possible outcomes. The first is another round of bailouts, with the Federal Reserve turning on the money printer. In that scenario, anyone holding wealth in cash or dollar-denominated assets would see their purchasing power erode rapidly through inflation. The second option is something we've already seen in places like Cyprus and Lebanon, a bail-in. In a bail-in, your deposits are used to recapitalize the banks. Accounts can be frozen. Access to funds can be restricted for months or even years. In some cases, depositors lose a significant portion of their savings, and during that entire period, the currency continues to lose value. If you think that can't happen in the United States, it absolutely can. It is fully legal. Bail-in procedures were written into law in 2010 following the financial crisis of 2008. Global banking institutions, including the Bank for International Settlements, have openly outlined this playbook. It's not the first choice, but it becomes the option when everything else fails. The real question is how long you could survive without access to your money. A month? A year? Longer? That's why it's critical to have protection outside of the banking system and outside of fiat currency. For me, that protection is physical gold and silver, tangible assets you can hold, control, and rely on when systems fail. We've all wondered how the banking system has held together this long despite everything happening beneath the surface. This is how. The surface is kept calm while the foundation continues to crumble. But that strategy doesn't work forever. I'm not suggesting a run on your bank. I am saying that insurance only works if you have it before the crisis hits. If you don't already have a strategy that includes physical gold and silver, now is the time to consider one. You can call us, scan the QR code, or download our free gold and silver guide to learn more. If this video helped you, please share it with someone you care about. Awareness matters. Thank you for being here.